Good afternoon or morning, depending on the area of the country that you're in. This is Curtis Hawks with Insurance Agency Marketing Services. And I am very excited for our presentation today. We've got a special guest host, Mr. John Solomon, who is the founder and CEO of Optima Financial and Insurance Services. And we'll talk a little bit more about him in a minute here, but we've got a very important topic today, which is taking a deep dive into the IUL landscape, specifically AG 49. We're going to touch on 7702 as well, and really give a good overview of some different things that are going on that really impact the design and structure of Indexed Universal Life. And I think what you'll find with today's presentation is that there's significant opportunity in this space. And with the current going-ons in the country and the potential for increased taxes, IUL just makes a whole heck of a lot of sense as a planning tool. So before we get into that, I did want to take a couple of minutes and chat a little bit about some of the additional ways that IMS can help support our agents. So first off, I've got our new producer builders up here on the screen. For those of you that are new to IMS that maybe haven't worked with us before, this is a great program where we can come in and meet you where you're at and help you to get to where you want to be. And so you can see a number of different options and point totals for how we can partner with you based off your production. What I would also encourage all of you as well to look at is if you're currently doing some things right now that work well for you, reach out, talk to a sales director over here. One of the things you'll find is we have a high degree of customization to our services. So we certainly want to support what you're doing that's working. And if you're looking to accent your current marketing mix or business, then certainly want to take a look at that as well. In addition to our new producer bonus, we've got our IMS business builders. And there's a couple of different ways that we can get additional revenue into your pocket. One is our referred producer program. So if you're currently working with us and like our service and know somebody that might be looking to make a change or that you just think might benefit from some of the things that we do, not only will you get a $50 bonus when that agent gets contracted with us, but in addition to that, you'll get an additional $100 bonus when that agent writes their first piece of business. And then on a quarterly basis, and these are some of the biggest checks that we cut, you'll get additional bonuses based off of their production. The nice thing about that is you don't have to do anything. We'll take care of all the service. We'll take care of that agent, but it's additional revenue in your pocket. In addition to that, we've got our marketing reimbursement programs. And as you can see there, for every $100,000 of indexed annuity premium, you'll get an additional $100 put into your account, and then $200 for every 100,000 of SPL or 10,000 of target life. And so this is a great way to double the size of your advertising budget. And that's one of the things that we've seen over the course of the last year as well, is not only do you have to be a little bit more tactical and strategic about your mix of marketing activities, but depending on where you're at in the country, you have to spend a little bit more in order to maintain that consistent flow of prospects. So if you have questions on that, certainly feel free to reach out and speak with one of our sales directors over here as well. In addition to that, our back office support. Now, everybody says that they have good service. I mean, I think we do, from a service standpoint, one of the best jobs out there, but I do think the pandemic's really highlighted the importance of having a good back office with your IMO relationship, as carriers have moved to have staff work remote, and we're seeing them start to bring people back into the office, but it's certainly, most carriers are nowhere near full staffing. So what I would tell you is we've got a very, very seasoned team of people here to support you, whether it's in the initial design phase of a case to submission to commission. In addition to that, if you need to get licensed with carriers, but I would encourage you, if you haven't tested out our back office support, you definitely need to. One of the things that I think we're all aware of is that incorporating digital elements into your business, whether it's meeting people virtually or even transitioning from paper application to e-application, has been an integral part of the last year. And so I did want to mention that we do integrate with Firelight on our website. You can see here the pool of companies that we have available, and we're always looking to add additional carriers, so we are in the process of that as well. But if you've got questions on Firelight, we do have that available on our site. In addition to that, we have iPipeline as well. So whether you're looking at annuities or life insurance, you can go to one site, which is the IMS Inc. site, and be able to do those. In addition to that, we've got our creative marketing solutions. And I think creative is really the key word here. The team does a very, very effective job of producing not only quality pieces, whether it's a website update, business cards, logos, marketing collateral, but one of the things that we've developed over the last year is our marketing analysis process. And so marketing oftentimes is one of the biggest challenges most advisors face. And a lot of the time they have questions about what's the right mix of strategies, what should I be doing? And so what we'll do in that process is go through, look at what your marketing assets are, what your target demographic is, what your goals are, look at all those different types of things, and then put together a customized marketing plan for you. And so I'd encourage everybody, we're getting into the second quarter now. Now is a great time to evaluate your marketing plan for the year. And definitely, I think if you haven't taken advantage of this free complimentary service, you need to. And I would encourage you to reach out to your sales directors to chat with them about that. In addition, our IMS website, and I talked a little bit about this a minute ago, but we really have a robust platform. Whether you're doing e-applications on the annuity or the life insurance side, you need to run quotes on annuities or life insurance, get access to forms, underwriting. We've got a variety of resources available on there. In addition to that, we've got our sales resource library, and there are literally hundreds of different point of sale pieces that you can use for live or virtual presentations. And it covers everything from basics about annuities or life insurance or IRAs or 401ks to the other end of the spectrum, to where we've got pieces on there talking about loan regime or economic benefit split dollar and everything in between. That's a free service that you have access to if you're a licensed agent with us. And so I would encourage you, if you've got questions about getting access to the IMS site, reach out, talk to one of the sales directors over here, and they can help you with that. In addition to that, as we know, being able to articulate complex concepts in a straightforward and simple manner has been important, especially in visual presentations or virtual presentations. And so one of the platforms that we use is Retirement Analyzer. It does a really good job in a simple and straightforward format of answering that question of, am I going to outlive my income in retirement? And so you can get access to that for free through IMS. I would encourage you, if you've got questions on it, would like to see a sample report or a demo, reach out to us, talk to one of the sales directors. The number is 800-255-5055, and they can help walk you through that. In addition to that, we do have an RIA, IMS Wealth Management. And I think right now is a great time to look at that. If you've been thinking about making AUM a portion of your business, now's a great time to look into that. If maybe if you're already securities licensed, you're not quite happy with your current relationship, Charles and his team do a great job and would be more than happy to get on the phone with you and chat a little bit about what they do and what their value proposition is and how they can help your business in particular. So certainly, if you've got questions on that, reach out to Charles and his team, and they're more than happy to take your calls and chat with you. Last but certainly not least, I did want to mention our Top Producer Summit. We did kick that off. That started in December of last year. It runs through June 30th of next year. And it really is, a big core part of who we are is we like getting together with our agents. We like getting face-to-face time with them. And so it was tough last year going through the pandemic, not being able to do these types of events, but we were really excited to announce this. And, we really wanted to make this an experience of a lifetime. The entire trip is all high-end concierge level. You can see it's going to be a Mediterranean cruise where we work our way around the boot of Italy. It's 4.5 million points to qualify. And again, that runs through June 30th. So I would encourage you to, if you've got questions on that and want to learn a little bit more about how you can qualify for it, reach out and talk to a sales director over here, and they can certainly answer any questions you have and get you some more information. And so with that, we'll get on to the main event. And with us today, as I mentioned, is Mr. John Solomon. And it is really an evolving landscape in the IUL space. We've had a few different things go on One was the implementation at the end of last year of AG 49. In addition to that, in the Consolidated Appropriations Act at the end of last year, there was a change to Section 7702 and how we calculate MEX. And so you've got two big things that have a dramatic impact on the structure of these products. In fact, a lot of the carriers in the IUL space haven't even necessarily rolled out their updated products. In addition to that, when you look at the current landscape right now, you've got a massive infrastructure bill that is working its way through Congress, and part of what's going to go along with that are some significant tax increases. And in addition to that, we've also got the sunsetting of the TCJA, which is how we currently file our taxes now. And so I say all of that to get to the point of there's an amazing opportunity out there in this space. There's an amazing opportunity with what cash value life insurance can do and how it can be utilized as a tax advantage savings vehicle. And so with us today is John Solomon. He's the president and founder of Optima Financial. And what I can tell you is I've had the opportunity to work with John, going on almost 12 years now. And he's one of the most knowledgeable.
When's our anniversary?
I know, right? But he's one of the most knowledgeable people I've met in the life insurance space, and especially in the index universal life space. So John, I really appreciate you taking some time with us today to kind of go through this and give us a deep dive into index universal life.
Thank you, Curtis. If there's a theme or a tone of this, it should be that, comparing policies under all these different regs is really difficult. I mean, it's really hard to come to any meaningful conclusion nowadays when you take a look at all these different policies. And, I used to do in some of my presentations, I do a history of life insurance, and it was super busy. When I hit the road, do road shows, I always like to just show people, how we got where we are. And it was really boring. But what I think I've done today was I went to the well and I made some changes to show some of the opportunities that really make sales for you, right? And again, I always like to talk about the January 1st, 2009. I went through this in the last webinar we did talking about it, but I went down a rabbit hole this time and I put together several slides on how we've used 1109 to make some sales. And then I want to talk a little bit about whole life and universal life since the 90s, what's happened. I'm going to show my policy again. I want to share some thoughts with you on that and how during the 90s, the interest rates went down, most of the ULs blew up, and it kind of created the birth of index life. But what really happened with index life and why we illustrated the way we did and how that came into being with AG 49, all the issues of AG 49 led to issues of AG 49A coming into play. And then AG 49A has some controversy and some issues in it. They've been highlighted with this new changes to 7702. And then last week I was chatting with somebody. I literally just threw this mutual companies as an afterthought in on a Saturday morning. I was talking to someone that's just a be your own bank guy and talking about all the things that he's been pushing for the last 15, 20, 25 years with whole life and all the mutual companies that use non-direct recognition. And I just want to say to the people that are selling Ohio National bid, what the heck happened? $500 to $550 million comes in. All of a sudden we have private equity in the mutual space. I'm actually putting together a presentation, Curtis. You and I can do another one where I'm just talking about specifically mutual companies versus whole life companies, but that's a whole new. Let me jump into this. So I always start with this slide, and I always like to say, it doesn't matter what you're selling. So I'm going to do a little deep dive into this page, a little deeper than I did last time. But it doesn't matter if you're in the annuity space, if you're doing AUM, whatever it is, you need some kind of a transition to get into talking about life insurance. And it can be something as simple as, I fix broken portfolios. We can talk about conversions. We can talk about underfunded policies. We can talk about expensive policies. Do you have the old kind of insurance or the new kind? Do you have chronic and critical illness riders? Or something like, I do life insurance, not like the kind you've ever seen. They haven't seen these policies that really do protect them from Wall Street, Washington, D.C., and the insurance industry, right? So there's just a great story to be had with those. And I wanted to make a quick mention of what's happened with COVID and a lot of the accelerated underwriting opportunities. At the end of this presentation, I'm going to mention a company that's coming out with 5-minute underwriting on an exceptional IUL with phenomenal cash values. And I'll go through that a little bit detail, but that's just one of the, afterthoughts, if you will, of COVID. But before COVID, we had LexisNexis, we had TransUnion, we had all these awesome data opportunities to collect information about people and minimize the underwriting process. And I mention that just because there's several advisors that, they say, I do annuities, I don't want to get involved with life, the underwriting process kills me. I invite you to readdress that, take a look at it. On the last webinar, I talked about this contingent beneficiary referral. And I just hope that someone's tried it. If any of you did, please let someone at IAMS know that you sat down, you did a life app, you did something, and you asked them about their contingent beneficiary referral. It's so relevant nowadays because we're doing Zooms. We can sell people all across the country, all across the world. We don't have to sit in their living room. They don't have to come to our office. And if you have the contingent beneficiary referral and you get that name, that's their best friend. That's their closest relative. That's somebody they can get you an appointment with. Please use it. Please try it. And here we go, January 1st, 2009. That's the day we switched from the 1980 to the 2001 CSO table. I'm going to go down a bit of a rabbit hole, as I just mentioned, talking about that, because it's really important for me to convey to you guys what really happened with all these costs of insurance. And of course, that's going to roll into what really happened to universal life versus whole life in the 90s, right? I really like talking about that simply because nobody funded universal life properly back then. And I'm going to start with this again. This is a policy I own today. And if you look at the bottom there, $117,000 is what I'm supposed to have, and $285,000 is what I'm supposed to have in death benefit. And if you think about that, all the fans of whole life, they've been bashing UL for their performance, since the 90s. They all underfunded. And I say that's hogwash. I don't believe that. And I think that UL was sold incorrectly. No one max funded UL in the day. If I put $1,200 into a universal life policy instead of the $650 that I was going to do at Target, I would have significantly more than significantly more than what I have currently, which is $52,000 and $140,000. Look at that. It's a significant difference. 285 versus 117, and I'm at 50 and 139. If I put that same money into a UL, I would have a lot more money than I do currently. And I just think that there's just too many people that don't really understand it. And this kind of segues a bit into what I'm talking about with January 1st, 2009. This literally shows the difference graphically between the 1980 CSO table and the 2001 table that started January 1st, 2009. You can see it's about a 30%, it's roughly 30% across the board for men on that table. That's a significant decrease. What does that say? That just says that if someone had one of these policies before, then they can buy a new policy and get a significant discount. But then I went a step further and said, let's take a look at this. Here it is again. What this one shows is the orange is the January 1st number. The blue, I'm trying to make this clear, is really a 2017 against the 2001. So again, it's significantly cheaper. I'm not a guru on this stuff, so I went to the well and said, let's make it simple and just do this for you. What this shows is what I'm using to make sales. A 60-year-old on the 1980 table, his cost of insurance was 61. You can see in 2001, the 2001 table that started January 1st, 2009, it was a significant decrease, okay? Significant. So take that again to what we just had happen last year with the 2017 table. It's now 25. It's gone from 61 down to 25. Now companies use their own numbers, but they're based on these numbers. In the last webinar, I showed these numbers, for accumulation products and what really happened. And I'm going to go through that slide again, but I want just everyone to realize that on a 60-year-old, it was 30% cheaper to go to 2001, and then another significant decrease to go to 2017. It's less than half. If you find a whole life policy issued before January 1st, 2009, it's a sale. If they're still insurable, it's an amazing opportunity. So I want to talk about this because, this whole life insurance didn't really lock in their cost of insurance if they bought it before January 1st. I want to make sure we understand what this is and what this is not, because whole life does not lock in their cost of insurance. The risk of dying gets, more expensive every single year, whether you're in whole life or any other policy. There's no magic pixie dust you can sprinkle on to change that, right? It's very, very expensive inside of a whole life versus a universal life policy for this reason, the CVAT versus GPT. If you think about it, if you have $1 of cash value, and I'm going to show this in a couple of slides, we have to buy X amount of insurance for that to satisfy these equations. And you have to buy more insurance with CVAT than you do with GPT, and I'll get to that. But I just want to talk about what really happens, because there's many people out there that just bash universal life for the cost of insurance going through the roof. And that's why a lot of whole life guys will always say, you know, I love mutual companies. I love non-direct recognition. We don't have this issue of cost of insurance going through the roof in older ages. And I say that the exact opposite of that is true. Our cost of insurance goes up less than it does in a whole life policy because of CVAT versus GPT. Let me show you what I mean by that. If you have a policy and it's $1 million death benefit, in the first year, if there's no cash value, you're buying $1 million. Yes, our cost of insurance is 10 cents, so we're going to spend, you know, $1,000. And as Nelson Nash and all the other whole life disciples say, our cost of insurance goes through the roof. You can look down there; it's almost tripled. But what they don't talk about is the rest of the story. As we get more and more cash, our net amount at risk goes down. Our net amount at risk goes down at a much higher rate than the costs increase. So the total money coming out of the policy actually goes down. And think of this. It's even amplified because the real rest of the story is that the GPT minimizes that. And what does that mean? Well, if I'm a 45-year-old and I have $1 of cash and I got to buy $2 of insurance on GPT, but I got to buy $3 of insurance on CVAT, that's a significant difference when it comes to the cost of the insurance and why we're more efficient than they are when it comes to accumulating cash value. We simply buy less. And what's even more frustrating to me is when I hear these people talk about, oh, if you bought a whole life policy, you'd be fine. Well, as you could see, I'm not fine from 1992. They always go through and say how much better whole life was than UL. Yeah, because UL blew up again because it wasn't funded correctly. And I haven't shown these slides in years, but I thought it was pertinent. I went and I found one. I think this is from 2014. But this is a study that was done every year up until 2013 or 2014 when Mr. Blease died. And what's interesting to me is what he did was he go back and take historical performance that was promised and that actually happened on whole life policies. And if you look here, you take a look at all the companies and what their illustrated rate of returns were to be. And what they actually did, you can see it's significant. You know, we're talking about doing 7. We gave you 3. We're talking about doing 7. We gave you 2.7. We gave 5.913. You know, some companies did better than others. But the whole point is, as you can see from my policy, it didn't do as well as it was projected to do. And Universal Life, had it been sold correctly, you know, should have been doing a heck of a lot better. So with that being said, let me jump back into what we came here to discuss today. You know, the 2017 table really started January 1st last year. And, you know, think about my UL policy and what the costs are going to be now. But there's really been some dramatic changes out there. And think about the changing environment of IUL contracts. This is what I want to cover today. I want to go over how they've been more than just retrofits. There's been significant changes, and it's created a war for illustrations, right? I want to stay on track here and talk about what happened, why we got AG 49 and why we got AG 49A and what really happened. What were the intentions of AG 49? I think the big takeaway is, as I showed you last time, and I'll show you again today, what AG 49 created was a huge discrepancy between the crediting rate and the illustrated rate on a index universal life policy, right? And I want to make sure I cover all these bullet points so that by the end you really understand what AG 49 did, what AG 49A could do, and of course I'll lead right into 7702, which is going to be our next presentation. So what really happened? You know, if we take a look at what these policies did, you know, the illustration rates were simply way too high. Whole life sales were going down and the carriers cried foul. They couldn't compete with it. So the NAIC stepped in and developed AG 49 to standardize illustrations, simply because before that, you know, companies would go back and say, oh, I'm going to go back 20 years. I'm going to go back 25 years. I'm going to go back 15 years with my cap and come up with the best rate of return for my particular policy. So there wasn't a standardized opportunity. And it was literally the Wild West out there. And what advisors didn't realize was they were showing 15% distributions. Well, what do I mean by that? You know, at age 65, 100,000 would would just somehow show $150,000 coming out. Oh, hey, by the way, that $1 million is now $2 million 30 years down the road. It just wasn't realistic. Hence, the regulator stepped in and said we needed to do something, because There wasn't a standardized way of doing it. And what really shocks people is when they really understand how these 15% arbitrages came to be. The distributions were based upon these ridiculous rates, 9% crediting rates over a 6% cost for the insurance. It was just too much. So it just doesn't make any sense to keep going forward. So they came up with these new rules. Now, what they really tried to do was, simplify and reel in the illustrations. So what they did was they defined an illustrated rate that was going to be uniform for everybody, and they did it two ways. They did these 65-year look-backs going forward, 20, 25 years, came up with tens of thousands of data points, or you could do something to generalize, say 145% of the general account of the company, what they were making times 1.45. And then, of course, they tried to set a maximum arbitrage of 1%. And it's just interesting to me what really ended up happening, because they also really wanted to say, we need alternate rate disclosures. We need some kind of a midpoint to really make sure people understand what happens if you don't get the illustrated rate of return. And it was really designed to level the playing field. But as I'm going to show you, I think you'll be shocked that actuaries got super creative. Some went over the edge, and they really wanted to fund these bonuses and multipliers with huge expenses. And I talked about that in the last webinar. I went into some detail, and I added it at the end. Just if I have some time, I'll go through that. But I want to make sure everybody understands, what the intentions of AG 49 were and what really did happen. And I want you to think about this, because this will shock you. I pulled this off the Society of Actuaries page, and this is going back to pre-AG 49. And what this is basically showing you is that they took Monte Carlo returns. They took these massive sequences of returns and they dumped them into these insurance illustration softwares. And what they came up with, hey, if we have a situation where the crediting rate, the average crediting rate with this Monte Carlo scenario, if it was greater than the illustrated rate on the policy, and again, pre-AG 49, you still had a 25% likelihood that the policy would lapse before age 90. Think about that. We have an averaging crediting rate that's higher than the illustrated rate, and it still didn't perform. If we wanted to take those loans all the way to age 100, we had about a 50% likelihood that it wasn't going to work. Then they went and did the same thing and said, if we ran this illustration at 7, what if we find the averaging crediting rate somewhere around 6, something lower? Then what's going to happen? Well, obviously, if we have a lower rate than we predicted, things are not going to be pretty. They're not going to even get to age 90, 74 to 83% of the time, and they're certainly not going to get to age 100. And what they really wanted to make sure we all understood was, hey, there's an issue here because we're putting ourselves in a situation. And remember the last presentation that I discussed, and I got into the returns and what happens to sequence of returns if you get a bunch of zeros. And I showed you what we can do to make these policies have a much higher likelihood of success. And I came to the same conclusion as they did. I love seeing these numbers when I found this. What they came to the conclusion of is, well, if we're going to go out and show you what happens with these numbers, and we're showing lower likelihoods of success than we would ever suspect, how can we fix that? When I talked about it, it didn't make a lot of sense. But if you look at it this way, if we go back to this slide and we talk about this 25%, how can we make these numbers come up to the 90% likelihood of success? In other words, instead of having a 25% failure rate or a 75% likelihood of success, how can we get these to be 90? And they came up with something very similar to what I showed you last time. All we have to do is lower the average rate by 8%, right? Lower the average distribution number by 8%, or lower the average distribution rate by 17% to get to 90% likelihood of success. I hope that's clear. In other words, if I'm showing $100,000 distributions, if I just drop it to 92, we're still going to make all the sales, and we bring our likelihood of success. If we're underperforming, if we take our $100,000 distributions and drop them to 83%, 83,000, we're going to have a 90% likelihood of success. I know this verbiage is confusing. This is a PowerPoint that I made a few weeks ago, and I had to email it to myself this morning while Curtis and I were having some issues. So I'm looking at 2 different PowerPoints on 2 different slides here. So I know that is confusing with the lower average interest. I should say lower distributions. So hopefully that makes some sense. And again, I wanted to cover this real quick just to talk about what it shows. And to me, this is very important to understand everything I keep talking about when it comes to the likelihood of success with AG 49A and the illustrated rate versus the crediting rate, because to me, that's what it's all about. It's understanding what would happen. Remember, if we pre-AG 49, if we were illustrating at 8.43 and AG 49 had us drop down to 6.85, we have lower interest rates. But even with lower interest rates, our income went up and our fees went through the roof. How is that possible, right? And what I want you to understand from this one slide is that if these illustration numbers have an increase, obviously we didn't have a decrease in the illustrated rate. This 6.85 obviously has to be something higher than 8.43 to make these illustrations go up. And that's really what I want to focus on today, to make sure we all understand what happened and really understand why that happened, because it's all about the illustrated rate versus the crediting rate. Let me show you what I mean. So if you take a look at two policies, and again, AG 49 is interpreted in many, many ways. So it comes down to the illustrated rate versus the crediting rate, what they are, and more importantly, what they are not. The illustrated rate, think of that as the little number at the top of the page. You punch in 6% to the computer, but the crediting rate is what's actually credited to the policy. So let's look at these two different policies. One of them's got a 12% cap, and the other one's got a 10% cap with a 15% bonus. Under AG 49, they both have a 7% crediting rate. But with the 12% cap, you get 696. With 10%, you get 6.09 as the crediting rate under AG 49, plus you get your multiplier to make these things equal at 7%. So the illustrated rate is both 7% under the same situations. But the outcome is so different. Let me explain why. If you have a loan rate of 5%, the first one with the 12% cap, you're going to get 6% because you can only show 1% over the 5%, right? So if you have a 12% cap, gets you 696. We can't credit the loan with 696. We can only credit with 6. But think about this one. A 10% cap still covers the cost of the loan, so we got our 10, but now we get to use the multiplier, and that is the 1.15. So we're going to have 6.9 over 5. That's a much different arbitrage, 1.5 versus 1. That's going to give you a lot more money. Right? Think about that. 12% gets you 696. 10% with the multiplier, gets you basically 7. They're virtually identical. Now, is this bad? No, but it could be. It's worse if it's not guaranteed. But these are the types of issues that really came to AG 49 and AG 49 coming to follow it because people didn't understand this. They don't understand how this really works. And to me, is it a bad thing? No, if you understand the risk, right? Do we understand that there's a cost to this? And we understand that zero is not your hero if we have fees associated with this. And again, I just want to say, through this in here, IUL can do three things for you. Protection from Wall Street, IRS, and the insurance industry, right? You're never going to have a losing year. It's tax deferred. You get free money out. And of course, you get the chronic and critical illness riders. These policies will have trouble doing 3, and they really can't have trouble doing 2 and really can't do 3 of these things for you. Why do I say that? I just want to make sure that people understand how they work and how they don't work. So back to the AG 49 and what happened. Illustrated rates relative to crediting rates are very different than anybody expected when they came up with these numbers. Product designs, they didn't contemplate what people were going to do, what actuaries were going to do. They didn't realize we were going to see this onslaught of multipliers and bonuses and index credit enhancements. So I'm going to show you a slide. I think this should shock you. But, a decision was made that products with enhancements, shouldn't illustrate any better than products without these enhancements. And why? That was the big change from AG 49 to AG 49A. They really wanted to take away the bonuses and the multipliers. They didn't want them. And then, why? Why were they such a problem? This, I hope, shocks the heck out of you. I was working with an agent. He wanted to be conservative. He sent me this illustration. He went to this company and asked for a very conservative illustration, ran at 5%. And take a look at this. In year 10, there's $400,000. So there's this 5%. Okay, so there's my 5%. I'm looking pretty good. But what he didn't realize, included in the illustration, on top of the $21,000, which was his 5%, there was another bonus for $38,000. So the total index credits are $60,000. He thought he was showing 5%. Think about that. This is 3 times as much. This is a 15% crediting rate. Now, is that bad? No, because he has the opportunity to get the upside. But what if he got a 0? this fee is still going to be charged. We have a $28,000 fee. This is one of the outliers I showed last time when I showed you all the different policies and how they're comparing with AG 49. Hence, we have AG 49A. So if we get a 0, we're not going to see a $60,000 increase on this policy, but we are going to see a $28,000 decrease. That's significant, right? I want people to understand there's a huge difference between the illustrated rate and the crediting rate. I probably said that 4 or 5 times. And you know, a lot of you know I work with Rocky and we send a lot of stuff out, and I give a lot of stuff to Rocky that he does on the life side. I'll take credit for the good stuff. You know, I know he irritates people, but he sends a lot of controversial stuff out. But this one's really powerful, making sure people truly understand how this stuff works, and again, how it doesn't work. So let's go to what happened to follow. Because of that, in a nutshell, AG 49 came along and really wanted to simplify and eliminate the ability for insurance companies to illustrate charges for the purpose of cranking up returns. You know, they had to try to set a maximum rate that people would hold to, no more multipliers to blow past the illustrated rate, and the crediting rate had to be more in line with the illustrated rate. That's really the intent of AG 49 when it came in here. Bonuses can go beyond the benchmark. It's kind of a controversial thing. What do I mean by that? Well, every company has to come up with their own rate of return, and if they illustrate it lower, they can use a bonus to get up to their maximum rate. So they can only illustrate a 0.5% loan arbitrage. Again, this is an oversimplification of a 5 or 6 page rule, but I want to say this: show me any company that's really maintaining a 0.5 bip or 0.5 point arbitrage on their loans. They're simply not happening. So what does that lead to? What kind of problems are we going to get into? I'll say this: there's a big trade-off now in what's happening in the industry. You know, if you take a look at this company ABC and their benchmark that they can actually illustrate as 5.25, and they have a guaranteed bonus of 1, they can actually get the crediting rate to 6.25. XYZ, they have a benchmark of 5.5, roughly the same. Let's just say they opt for a 25-point multiplier. They can't show that multiplier anymore. So the allowed credits are 5.5. So now you have 2 different companies, one showing you 5.5 and one showing you 6.25. Are they different? Significantly. Which one has a higher likelihood of success? I would argue that the multiplier does, and I can get into that in a minute. But just think of it this way. If you had your investment and you knew that you were going to pay a 1% asset fee, and if you take a look at the history of the market, that 1% fee, if the market only does 2 or 3% every year, it's not worth it to get a 25-point multiplier on 2 or 3 points. So the crossover point for that 1% is basically 3.5 to 4. So if the market does better than 3.5 or 4, that 1% cost to get your 25% multiplier makes a lot of sense. Does it make sense to pay 6% to get the multipliers I showed a few slides ago? Probably not. But I would say 1% is advisable, 6% is risky. So if we take that 1% guarantee and get that 25% multiplier, it illustrates not nearly as well as ABC does, right? I get that we need to show all these numbers to try to get my point across here, but I guess I want to say this: illustrated strategies shouldn't be used long-term in the policy if they're not going to perform as well as other ones. In other words, I'm going to show you one that illustrates the best, even though it might not do as well as other opportunities. And in the last webinar, I really went deep into risk premium and how these companies can go ahead and try to make money for us, right? And what have they done? Well, they've used the use of non-indexed bonuses. You know, I talked about VCIs and went through VCIs and how they work. And that's kind of interesting. And the big thing to me was the reduction in the interest rate spread, right? Putting money towards bonuses. Like I just mentioned, instead of buying multipliers, does that make sense? Well, it makes sense if you want to have the best illustration. And again, policies designed to motivate the desired policy outcome. In other words, they're trying to create the best illustration to get people to buy. The best illustration has a low chance of outperforming other strategies available in the policy. What do I mean by that? Just because you're showing one bucket inside of a policy, that one doesn't have the best likelihood of coming to the best outcomes 20, 30, 40 years down the road. My new words for 2021 is practically guaranteed. I believe that the illustrations that we show today are practically guaranteed to not perform as well as other ones. And let me show you how we can get these policies to perform and how we make money. So what is the yield on premium? It's a great story. I don't want to sit there and bash IUL. I want to make sure we understand it, because even today, with low interest rates and high volatility, we have a phenomenal story to tell. And what can we make on the money I put in this policy? What can we expect to make? I'm going to break it down for you, make it simple. The bond portfolio yield, the general accounts of the company, they're general, they are bond portfolios. And what do? They take that money, and as I talked about last time, they try to create a spread, the IUL risk spread. We can try to take that money and increase it by buying options and never losing the money, right? That's what we always talk about. Zero is your hero. And traditionally, all these companies have done better than 2%. So if I have my bond portfolio, I have my risk spread of 2%, I'm going to subtract my policy cost. But what are the fees inside the policies? Let me show you how we do that. They're different, many different ways based upon how you structure the policy. If I'm going to sell a policy, if I'm going to sell a policy at target premium for 10 years, if I take my internal rate of return and subtract it from the illustrated rate, that's what my fees are, right? Illustrated rate minus internal rate of return are the fees in the policy. So if I'm going to come out and show you, look, if I ran this at 6% and I know that my internal rate of return was 3%, happens to be a 3% cost, I can look at this one and say, hey, if I pay a MEC premium for 7 years and I ran this at 6%, I know that my internal rate of return is 5.41, right? That's just how these work. You take this internal rate of return and you subtract it from the illustrated rate, and you can come up with these numbers. So these are the fees if you run it at, a 20-year non-MEC, get you down to 0.28. So in other words, I can tell you, you're going to make 5.72% off of a 6% illustrated return. My internal rate of return can be 5.72%. That's significant to me. The story's strong, the story works. Let's talk about the risk premium. This just shows if our fixed account average for these 12 years, 4%, 4.25%, we're able to get close to 7%. That's almost 2.5%, a little over 2.5% risk spread. By buying options, these companies are able to increase the returns that they can offer you with very little risk. So if I tell you that these numbers were the costs, 0.28 to 0.59, I think it's pretty fair to say, I'm going to show you a bond portfolio from a company of 4%, which is low. If that number is low, and an average risk spread of 2, which could be low, and the policy cost of 0.5 to 0.1, which are low, it's a phenomenal story to say we can still net 5% to 5.5% on these policies. I love to say this. How much would you put into an opportunity that can net you 5% tax deferred, tax free, as long as you have 15 years or more? That's a heck of a story. We need to lean on that instead of trying to make these things what they're not. But what are the overall implications of this? What can we really do to make sure that these things are done correctly? The IUL has a risk spread profile that's done really well. Like I said, it's done over 2%. All carriers have done this. But to make it work, like I mentioned, you really need to have 15 years. You can say 10, but then they need to be preferred and probably have a need for the insurance. But 15 years it works. You need to overfund these things to make them work. Volatility. I talked about that last time in the whole talk of volatility controlled indices, and I want to get into that. But making sure that you're in the right policies each and every year is impossible. The worst thing you can do is chase returns, right? Don't look at someone's annual statement and say, oh, that last year this one was the best, and then you put all the money into that one. That's the worst thing you can do. But volatility is both a blessing and a curse because of what you can do with it. And AG 49, I want to just keep it simple as I roll into the volatility controlled indices, because the whole concept of having a problem with our illustrations really came from these multipliers, right? If there was an issue for AG 49, I would have to say it was the fact that the illustrator rate didn't come anywhere near the crediting rate because of the multiplier, right? The multiplier was a big issue. And the issue for AG 49 that's coming up is volatility controlled indices. They're less expensive to purchase, and they leave money for guaranteed bonuses above and beyond that. So let's talk about that. What does that really mean? VCIs, what are they? They're sold as the S&P with training wheels, right? And if you have the volatility in the market, we're going to shift over to something that's much safer so we can minimize some of the volatility in the market. And we've seen the VIX go from 80 to, I think today, last I checked this last week, is somewhere around 16. But what if we have such big volatility like we did back in March, where the bonds and the other opportunities we move out of and we go into, if those have some volatility. That's a little scary thing, so you wouldn't want to have all your money in that bucket. And then there's also some other ways to look at volatility controlled indices where they actually have, a default on that side. That's a very scary thing, and that's a whole nother, that's Index Life 301. That's very, very detailed and very deep. So we'll save that for another day. But there is a volatility controlled index that does have a third leg that actually has a cash account. So if we have issues with the bonds, issues with the indice, we can actually get into something that's in a cash account. That makes sense. And again, how do we minimize risk in the market? Well, there's really only two ways: time and diversification. I talked last time, I showed those 4 or 5 slides about why it's so important to be diversified and try to hit a bunch of singles and doubles to get a bigger rate of return. Most importantly, what we really want to do is we want to avoid the strikeouts, right? And think about this. My issue that I have with volatility controlled indices is they illustrate best. But 10, 15, 20 years ago, would they have been the best opportunity as the market was just going straight up? Probably not. So you don't want to tie everything to those for 40, 50 years. Now let me talk about this. This company is a phenomenal company. It's a very strong policy, very strong company, and they have a great volatility controlled index. So let me just go over how it works. This thing has a 20-year look back of 5%. Add that 5, that's a very strong, and there's not many that have a 20-year where it's actually been around 20 years. Add to that their 135 participation rate, that would get you a 6.75% rate of return. Add to that the 15% multiplier, we get it to 776. I would argue this is conservative because if we go back 20 years for the 5, if interest rates were higher, we'd actually have more than 135% participation rate, okay? Then in year 11 with that policy, you still have the same thing, a 5% opportunity. You have the 135%. The multiplier drops to 10, but they add an interest bonus of 1%, okay? I would argue this is a good situation where we are going to underpromise and overperform based upon history. Now, it's a great position for that, but why does it illustrate so well? This is one of the best illustrating policies out there. And it illustrates well because they have an asset charge that they charge to every index on the policy, but they don't charge it in this strategy. It's like getting a boost on the illustration. If they have an asset charge of 75 bips, but we're not going to charge it, we just added 75 bips, okay? Is that sneaky? No, these are very inexpensive compared to other opportunities. A volatility controlled index is much cheaper to hedge than the S&P 500. So let's say this company, they have a little over 6% crediting rate on their illustration. But what they do is they have the illustrated rate set at about 5, a little over 5.5, because they want to include the 15% multiplier. And it really does help in the real world, but it doesn't help on the illustration. And again, think of it this way. They have this inexpensive volatility controlled index, has this 135% par rate, and a 1% bonus. And since they're waiving the 80 bips, it just goes through the roof. Looks phenomenal, but do you want to be in a volatility controlled index for the next 30, 40, 50 years? I don't know. Most products have these guarantees that crank up distributions. That's what you've really seen this whole difference is. This 1% bonus, right? When you get this annual bonuses, they're using it so they can crank up their distribution rates. I really believe that. So you have to understand how all these things work so that you can come back and have a good understanding of which illustration you want to show. Again, I think I understand that we don't want to be out there talking about one product that doesn't illustrate as good as another one. That's a really difficult situation to be in. It's tough to sit there and talk about how we can do that and feel good about ourselves, right? Are you sure the marketer that you work with understands why they're recommending this product, right? And this line is just crazy, but I love saying it because a poor product that's designed properly is far better than the best product poorly designed. It's a mouthful, but I just want to make sure we all understand that the inner workings and hidden mechanisms in these policies do have an effect on the outcome. Do you want the best product or do you want the best illustration? Because they are not the same thing. I think there's a big difference between the best product in the market and the other ones that actually outperform with illustrations because there's some, I don't like to say games, but there's definitely some things happening out there with what they're trying to get done for themselves. And in this time, during these days, are there companies that have advantages? I would say absolutely. There's a company out there that's really responsible for a couple things that they've brought to the marketplace. And they happen to be one of the largest annuity companies out there. And that's why I put this out there. Is your company an annuity company? And to me, I have an asterisk there to remind me to say this. It makes a lot of sense to me to be talking about the ability to hedge. And if you're not buying a bunch of indexed annuities to go along with your index life portfolio, I don't think you have as much of an opportunity to keep up with the other companies that are not doing that, right? I like to be the redheaded stepchild when I go to these meetings because I'm the life guy at an annuity company. And to me, that's a really big company. And my 4 favorite companies happen to all be annuity companies first and foremost, and then they are life companies. Do they hedge internally? That's a really big deal. That saves money. You know, last time I was showing you the difference in a 10% option and an 11% cap option. They're very little. Every 15, 20 bips makes a big difference. So if one company's trading billions of dollars a day and saving a little bit here and there, that makes a big difference, right? Does your favorite carrier invent many of these options that we're using inside these policies? The monthly sum, the blended index, the trigger. You can all tell what company I'm referring to when I say that. But this company's been in it for a long time, and they're in it to win it, so to speak. Company A, here's another company. And again, on the last webinar, I mentioned 10 different companies, and I went through all those different things. I'm not here to give you guys a bunch of interest and leave IMS and go someplace else and just say, hey, I just saw this webinar that said how great ABC company was. I want you to talk to IMS and talk to the marketers and get an idea of what it is that they have to offer you, because there's a company out there that has the best loan in the business, has the best S&P cap, has an amazing volatility controlled index, has an IUL coming that's 7702 qualified, and it's going to pay commission on the entire premium for 20 years. And let me just take a few minutes, and maybe I'll roll over my hour here, or 45 minutes, Curtis, but I want to say this. Think about a policy where you have a $10,000 premium. And if you max funding minimum death benefit, your target's $3,500 to $4,000, 35 to 40%. And let's just assume you're at street commission at 100%. So you sell a $10,000 premium, you're going to get paid, call it $4,000 on the high side. Imagine that $10,000 premium and you get paid 10% for 20 years, 9% for 20 years, 8% for 20, whatever the number comes out. And what they're going to do, it's coming in July and they'll have all the numbers by then. But let's just say it's 9%. That means your crossover is 4.5 years, right? So you're going to get 9% of 10,000, you get $900, 4.5 years later, you got $4,500, and then the rest is gravy. But think about what that does for the company. They're not putting out these large dollars to start, right? They're not going to go pay a giant cost for the insurance. A giant cost for the commissions. And more importantly, they're only going to pay if the premium comes in. That's just huge. 15 years down the road, if you're not paying the whole premium that they expected to get, they're not going to pay you a commission. That's just so awesome for the upside potential in the policy. Now, this company also has an underwriting decision in 5 minutes opportunity for you. There's an amazing policy with premium and persistency bonuses that you can literally give to your client in 5 minutes. Ask a few questions. They have an algorithm built in with LexisNexis, TransUnion, all these other opportunities, prescription database, the MIB. They can give you a policy in 5 minutes. And the best thing about this company that I think is just one of the strongest things I could say about any product is they never changed their products back in the day to conform to AG 49. AG 49A, they said, you know what, we don't want to have the best illustration. We think we have the best product. Well, now you fast forward through AG 49 and AG 49A, they have the best illustration out there. It just looks amazing. I just think that they're not the company that changed the philosophy behind their product just to have the best illustration. That to me is really important. By the way, if you take a look at what they've done, here's their published cap rates on the S&P 500. How do they do that? They take fees a little differently and have a better option budget than other companies. We will do a lot more on this coming soon. Now I'm going to end on this, pretty much on time. 7702, what happened? What's interesting is that the whole industry was kind of thrown into a loop this year when this new 7702 rule changed, right? In 1988, the 7702 basically said, hey, we have to guarantee these policies at 4%. And if you look at this is a 55-year-old, and it's an $800,000 policy. And you can just tell by looking at the graph, it's an $800,000 policy because at $800,000, he's 45, so it's age 100. It endowed on this 55-year-old at $800,000. What's interesting to me is this is the guaranteed cash value. All these companies, the only difference with the guaranteed cash value is what they paid into it. Slight differences, right? So what this is showing you is 800,000 in Dows at these premiums at 4%. And what happened was we had this new rule where that 4% just dropped to 2%. So obviously, if we put these premiums into these policies, we're not going to get $800,000 at age 100. At 2%, we're going to have something less. Let's just say it's $600,000. So we have $600,000 instead of $800,000. That tells us a couple things. Number one, we can now put a lot more money in to get us back to the 800,000, right? That's the big difference now. We can put more money into the smaller death benefits. But the inverse is also true. If this is a $600,000 endow now with this new 2% rule, we only have to buy $600,000. And this leads me to the big talking point that we're going to get into next time, the proverbial three-legged stool that is the insurance company. The insurance company has three people they have to be concerned about: themselves, us, all the distribution, and the clients, right? So there's three of them. What this rule has done is if it just cut the interest rate down to 2%, we can lower the death benefit. What happens when you lower the death benefit? Think about that. When you lower the death benefit and we put the same amount of money in, well, we're going to get paid less. So if the producers, if the distribution had their commissions cut, what does that do for the client? Wouldn't you think that if we got our commissions cut by, if we dropped this 800 to 400 and we got our commissions cut by 50%, wouldn't you think, wow, that's incredible? There's got to be significant upside for the client. And the answer is no. If we drop this death benefit from 800 to 400, how come there's not a giant increase to the client? And the answer is this. You know, back at the beginning of the policy, the cost of insurance is so low. And I ran a 45-year-old on a $7,500 premium with several companies. If you take that 45-year-old and that $7,500 premium, you look at the cost of the insurance. The cost of the insurance in that's about $200. So if I drop that death benefit by 50%, I drop that $200 down to $100 into $7,500. Does that make a big difference? No. Yes, there's some other fees, there's unit charges and things like that, but I'm just trying to keep it simple for you. The idea is this: there's about a 5 or 6% increase to cash value for a 50% decrease in commissions. Is that fair? I don't know. The insurance industry is kind of squabbling and tangling with that right now, trying to figure out what to do. No one's pulled back the curtain and showed us what's going to happen. I've talked to several carriers. There are some carriers that are saying, hey, if we keep you whole, we can still have the insurance do a little bit better than it's doing now. Other companies are saying, we're going to let you decide how you want to sell it. There's and everything in between. So there's lots of opportunities, getting rid of the whole notion of, you know, having commissions based upon a target premium. That's getting thrown out. I talked about that one company A that's going to be doing something like that. So there's a whole bunch of things that are coming, and by our next call, we'll be able to cover that in a little more detail. And one more thing I just want to say, this is interesting. If you find a policy January 1st, 2009, look in the basis of values. Every one of them shows this, that the policies are guaranteed at 4%. I'll just leave it at that. Curtis, back to you.
Well, I appreciate it, John, and appreciate you taking some time with us today to take a deep dive into this. And I hope what everybody's seeing is that, you know, again, there's significant opportunity in the index universal life space, but there are also a number of nuances with how you structure and design these. And so what I would tell you is the team over here at IMS has a significant amount of experience working with these products, structuring them, structuring cash flows, and I feel like we're one of the best resources you're going to find out there. In addition to that, we have a number of opportunities for if you're wanting to get in front of more prospects that are interested in these types of solutions. We've got a number of marketing programs available. So reach out, talk to your sales director over here. The phone number is 800-255-5055. Last couple of points that I want to make is John obviously covered a significant amount of material over the course of today. We do have a white paper that he authored available for attendees. So if you're interested in getting that, certainly reach out to the sales directors. And as John mentioned, we've got the third installment of our IUL Advantage webinar series coming up in May. We're really excited about that. And as he'd mentioned, we're going to be taking a deep dive, not just into the impact of 7702, but also looking at carriers and products as well. So appreciate, John, you taking some time with us today, and I appreciate everybody taking some time out of their day as well to be on this call, and look forward to speaking with you. Thanks.